In this video, you'll learn about the first step in the 9-step accounting cycle, which is analyzing business transactions. The 9-step accounting cycle is the continuous process of recording and presenting accounting information so that business transactions become usable and understandable to those internal and external users who need to make business and financial decisions. The accounting cycle starts with the analysis of business transactions. But what exactly is a business transaction? A business transaction is any financial event that changes the resources of a firm. For example, purchases, sales, payments, and receipts of cash are all business transactions. The accountant analyzes each business transaction to decide what information to record and where to record it. To learn this process, at the very beginning of our analysis, we will use a simplified version of the fundamental accounting equation, property equals financial interest. Most students learn best with examples, and one of the easiest ways to learn about analyzing business transactions is by studying the transactions of a service business. Our analysis starts with Eli's Consulting. Eli's Consulting is a service business and provides a wide range of accounting and consulting services. The owner of the business is Trayton Eli, who is a CPA and has a master's in accounting. The business also has an office manager, Sergio Sanchez. The office manager has an associate's degree in business and has taken 12 semester hours of accounting. Every month, Eli's Consulting Services bills clients for the accounting and consulting services provided that month. Customers can pay in cash when the services are rendered or receive credit. But you'll learn more about that later. To start the business, though, Trayton took money from his personal checking account of $100,000 and opened a checking account in the name of Eli's Consulting Services. Why do you think Trayton opened a new checking account? Well, the separate bank account helps Eli keep his financial interest in the business separate from his personal funds. The $100,000 transaction is the very first business transaction, and we need to figure out what to do with it and identify how it affects the equation property equals financial interest. Aside from the $100,000 business transaction, there are other business transactions for Eli's Consulting as well. And in all, we have 12 transactions to analyze. Small businesses may only have a few transactions in a day, but larger businesses have thousands or even tens of thousands of transactions in a day. I won't read each transaction now, but we'll cover each one of them in this video and the next. Before analyzing these 12 transactions, though, let's now talk about the simplified equation first. Property equals financial interest or obligation. Every business transaction involves at least two parts. Later, we will call that a debit and a credit, but for now, we'll only talk about increases and decreases. Property includes things like cash, monies owed by customers, called accounts receivable, equipment, office supplies, building, land, expenses paid in advance, called prepaid expenses, and inventory. In short, these are monies that the company owns. Financial interests and obligations are monies owed by the business, such as monies owed to suppliers, called accounts payable, bank loans, notes payable from supplies, monies received in advance from customers, and monies owed to the owners of the business. A transaction might impact both the property and the financial interest. meaning that both sides increase or decrease. Another transaction might increase one property category and decrease another property category, where yet another transaction might increase one financial interest category and decrease another financial interest category. After every transaction, though, the equation must still hold true. Property equals financial interest. We'll now look at the first business transaction for Eli's Consulting, but keep in mind that not every business event is recorded. We only record transactions that can be measured in US dollars and change the resources and financial interest of the organization. There are two major steps to analyzing business transactions. We first describe the financial event by identifying the property, which in our case is that the business received $100,000 in the form of cash. Then we identify who owns the property and who has the financial interest. For this transaction, Eli has $100,000 financial interest in the business. Next, we determine the amount of increase or decrease. The business now has $100,000 more cash, and Eli now has $100,000 more interest in the business. That means that property increased and the financial interest and obligations increased as well. So let's enter the transaction into our table and calculate the new balance. The second step is to make sure the equation is in balance, which is the case after this first transaction. $100,000 in property equals the $100,000 in financial interest. In the second business transaction, Eli's Consulting Services issued a $5,000 check to purchase a computer and other equipment. So let's analyze this. The firm purchased new property, equipment, which means that the property increased. The firm also paid out $5,000 in cash, which means that the property decreased. We'll add another category for equipment on the property side and write plus $5,000 in the equipment column and write minus $5,000 in the cash column. Does our equation still balance? Yes, it does. Let's look at the third transaction. For our third transaction, we'll analyze the following transaction. Eli's Consulting Services purchased office equipment on account from Office Plus for $6,000. Buying on account means that you don't pay the full amount right now. However, we have to keep track of the amount owed and the equipment purchased. The firm purchased new property equipment for $6,000, which means that property increased. Eli's Consulting owes $6,000 to Office Plus, which means that the financial interest and obligations have increased. We'll add another category for accounts payable on the financial interest side and write plus $6,000 in the accounts payable column and write plus $6,000 into the equipment column. Let's check if our equation still balances, and it does. These activities are recorded for the business entity Eli's Consulting Services. Trayton Eli's personal assets, such as his personal bank account, house, furniture, and automobile, are kept separate from the property of the business. Non-business property is not included in the accounting records of the business entity. Here's the fourth transaction. Sanchez purchased supplies so that Eli's Consulting Services could start operations. The company that sold the items requires cash payments from companies that have been in business less than 6 months, something that's very typical and common. Eli's Consulting Services issued a check for $1,500 to Office Deluxe to purchase office supplies. So what happened here? The company's cash decreased and the company increased supplies on hand. So let's write that into our table. We'll add an additional column for supplies and add $1,500. And we'll subtract $1,500 from cash. The new cash balance is now $93,500. When we add up all property accounts, cash, supplies, and equipment, the sum is $106,000, which is the same amount for the financial interest accounts. Therefore, our equation still holds true. Let's look at the fifth transaction. The office manager, Sanchez, pays $2,500 to Office Plus to reduce the firm's debt. This is related to our third transaction when Eli's Consulting bought computer equipment on account from Office Plus for $6,000. When we analyzed that original transaction, we increased computer equipment and we increased accounts payable. Now that Sanchez pays part of the $6,000 that Eli's Consulting owes Office Plus, we need to reduce the accounts payable account, but we also need to reduce the cash. So we deduct $2,500 from cash and we deduct $2,500 from accounts payable. The sixth transaction is about Eli's Consulting renting offices. In November, the office manager, Sanchez, arranged to rent facilities for $4,000 per month, beginning in December. The landlord required that rent for the first 2 months, December and January, be paid in advance. The firm prepaid, meaning paid in advance, the rent for 2 months. In accounting, this right is considered a form of property because the business could get a refund potentially if it did not use the facilities the entire time. Eli's Consulting Services issued a check for $8,000 to pay for rent for the month of December and January. So what do we need to do for this transaction? We need to add an additional account called prepaid rent to the property side of our equation and add $8,000. And we also need to reduce cash by $8,000. Why is the rent payment not an expense? Payments for expenses are not actually recorded as an expense until such time that the company incurs the expense. That means we can't recognize the rent for December of $4,000 until we close the books for the month of December. Until such time, it is considered property of the company. We'll learn more about such transactions like prepaid and accrued expenses later. The table we've been using provides us with a lot of information already, such as how much cash is available, how much the company owns in terms of supplies, prepaid rent, and equipment, and how much the company owes to others. Another way is to use this information is to prepare financial statements that external and internal users can readily understand. Why not use this table for external and internal users? Well, a standardized format is much easier to understand and compare. We prepare our first financial statement, the balance sheet, by listing all property accounts as assets. On the other side of the balance sheet, we list the financial interest accounts as liabilities if money is owed to vendors or other creditors. And we list the money owed to the owners under accounts owner's equity. The balance sheet shows the firm's financial position on a given day. In our example, Eli's Consulting prepared the balance sheet as of November 30th. The fundamental accounting equation, also called the balance sheet equation, represents the relationship between assets, liabilities, and owner's equity of a business. The fundamental accounting equation states that assets equals liabilities plus owner's equity. Another way to state it would be to say when we subtract all liabilities From the assets, we find the owner's equity or net worth of the business.